All right, let's just jump right in. For years, if you've been following NIO, the story has pretty much been the same. All about growth, but also a lot of cash burn. Well, a new, really detailed analysis is painting a completely different picture for the future. So today, we're going to break down this super bold bull case for NIO, piece by piece. And this analysis, it doesn't pull any punches. It kicks things off with a huge provocative question that just grabs you right away. Could NIO stock really be heading to $55? I mean, that's a massive claim. So let's dig into the logic and see how they even get there. And there it is, $55. That's the specific price target we're talking about, and it's projected for the year 2026. The entire argument we're about to walk through is basically a roadmap designed to justify how the company could get from where it is today all the way to that specific valuation. So what's the big idea here? Well, the whole thesis boils down to this one phrase, the profit supercycle. And this isn't just about, selling a few more cars. It's about a fundamental, ground-up shift in the company's entire financial structure. We're talking about moving away from being a high-growth, high-spend startup to entering a whole new era of massive profitability. This slide really just lays it all out, doesn't it? It perfectly contrasts the old story with the new one. For years, NIO was seen as a cash burn machine, stuck in this really heavy investment cycle. But the new story, according to this analysis, is that it's about to become a cash machine. It's reached what they call structural maturity, and it's ready to transform into a profitable tech giant. So how does a company actually make a pivot that big? Well, the argument is that the heavy spending phase, the part that's been eating up billions of dollars, is finally winding down. And it's happening in two key areas, research and development and all that physical infrastructure. And this slide shows you exactly why. Those massive upfront costs for core technology, the foundational intellectual property, are pretty much in the past now. And it's the same story for the battery swap network. The claim is that they've hit the density they need, which means that whole era of heavy, expensive construction spending is finally coming to an end. And look, this isn't some vague, maybe someday kind of prediction. No, this timeline is the absolute backbone of the entire bull case. They're pinpointing the fourth quarter of 2025 as NIO's first ever profitable quarter. That then leads into 2026 being the first fully profitable year. And that's the switch. That's the moment they believe will trigger a massive re-rating of the stock. But of course, you can't get to that kind of profit without massive, massive scale. And that's where the three-brand growth engine comes into play. This is a classic playbook. We've seen giants like the Volkswagen Group use it for years. It's designed to capture the entire market from top to bottom. So let's break this down because it's actually pretty clever. At the very top, you've got the flagship NIO brand. That's all about luxury, high margins, and brand prestige. Then you've got Onvo. This is the volume monster, aimed squarely at the mass market to go head-to-head with Tesla's Model Y. And finally, there's Firefly, the entry-level brand that's really designed for global scale, especially in markets outside of China. Now, I know what you're thinking. Launching three brands at once sounds incredibly risky. But the analysis argues that the risk is actually a lot lower because they all share a competitive moat. And what is that moat? It's the battery swap network, which also, conveniently, happens to be the foundation of a high-margin, recurring revenue model. And here's the crucial point. This network is incredibly difficult for anyone else to replicate. The source is crystal clear on this. It says that the billions in sunk costs and all the years of data they've collected make it something rivals just can't copy overnight. It's a really powerful competitive shield. This network makes a whole new business model possible called BaaS, which stands for Battery as a Service. So instead of buying the most expensive part of the car, the battery, you just pay a monthly subscription for it. For investors, this kind of predictable, steady cash flow is absolute gold compared to the up and down nature of one-time car sale. And BaaS is just the beginning. It's just the first layer. This model actually creates three separate streams of recurring revenue. You've got the subscription itself, then you have pure, high-margin software, like autonomous driving systems. And finally, there are the energy and service fees that get generated every single time a battery is swapped. It basically turns a one-time sale into a long-term cash flow relationship with the customer. Okay, so we have the strategy, we see the plan. Now let's connect all of that back to the final price target. This section breaks down the specific numbers for 2026 that really prop up the valuation math and bridge that gap to the $55 figure. It all kicks off with one huge number, deliveries. The model is projecting a really ambitious target of up to 650,000 cars in 2026. Now, it's absolutely crucial to understand this assumes near flawless execution. The launch and the ramp up for both Envo and Firefly have to go perfectly, and that is a significant operational challenge to say the least. Now, if, and it's a big if, they hit that manufacturing scale, the analysis then projects gross margins hitting 20%. This number isn't just pulled out of thin air. It's based on the assumption that those massive volume sales will be combined with the higher margin recurring revenues from BaaS and software that we just talked about. And those two things, massive scale and high margins, are what lead to this bottom line projection, an annual net profit of around $4 billion. According to this analysis, this is the magic number. This is the figure that acts as the trigger for the entire reevaluation of the company. A $4 billion profit. That's what leads to what the report calls a re-rating event. Just think of it like this. Imagine a student who's been getting C's their whole life, suddenly starts getting straight A's. The teacher is forced to completely reevaluate their potential, right? Well, in the same way, the market will be forced to reevaluate NIO, no longer as a speculative startup, but as a profitable tech giant that deserves a much, much higher earnings multiple. Okay, so this all leads to the big, obvious question, right? If this whole roadmap is so predictable, why on earth is the stock sitting at just $5? Well, the analysis argues that Wall Street is suffering from something called recency bias. They're still so focused on the old story of cash burn that they haven't priced in this future profitability at all. So that's the long-term vision. But the analysis also dives into the immediate short-term battle that's happening right now, today. It calls the stock a coiled spring at that $5 mark, just waiting to release. The key battleground is a technical indicator called the 200 moving average. For anyone who isn't a trader, don't worry, the definition is right here. It's basically just the average price over a set period, and traders see it as a major line in the sand, a boundary between a healthy trend and a weakening one. And this is where things get really fascinating. That entire long-term thesis we just walked through is being tested right now at this exact technical level. Sellers recently managed to push the price just below $5, but as this slide describes, buyers aggressively defended that level in what's called a hammer-like recovery. That shows real conviction, and it leaves you with a final provocative thought. Is this the moment that coiled spring finally begins to release?